Retirement may feel like a distant goal, but the truth is that the earlier you start preparing, the more secure and comfortable your future can be. Planning for retirement isn't just about setting money aside. It's about giving yourself the freedom to enjoy life on your own terms, without financial stress or uncertainty. Whether you're just getting started in your career or already moving forward in it, taking the time to understand how retirement planning works can dramatically shape your long-term financial security. The goal of retirement planning is simple: create peace of mind. By taking intentional steps today, you're giving your future self the gift of stability, freedom, and opportunity. Whether you dream of traveling, starting a passion project, or simply enjoying a stress-free life, a solid retirement strategy helps make those dreams possible. Now is the perfect time to take control, start planning, and build the future you truly want. Compound interest is one of the most powerful tools for growing your retirement savings. Unlike simple interest, which only earns on your original contribution, compound interest builds on itself by earning interest on both your initial deposit and the interest already accumulated. Over time, this snowball effect helps your money grow faster and more efficiently. Starting early makes a huge difference because it gives your investments more time to compound. Even small monthly contributions in your 20s can grow into a large nest egg by retirement. For example, someone who invests $200 a month in their 20s often ends up with far more than someone who invests $400 a month starting in their 30s. Time, not the amount, is the biggest factor in long-term growth. Consistency is another key to maximizing compound interest. Regular contributions, especially through automatic deposits, help you stay disciplined. Staying invested even during market ups and downs ensures you reap the benefits of long-term growth instead of missing opportunities during rebound years. To get the most from compound interest, use accounts that offer tax advantages such as IRAs or 401ks. These accounts allow your money to grow without immediate taxes eating into your returns. Choosing investments with strong long-term potential, while still balancing your risk level, helps your retirement savings accelerate over time. When deciding between an IRA and a 401k, consider your financial situation, your employer's benefits, and your long-term goals. IRAs allow you to save independently with the choice of either tax deductions now or tax-free withdrawals later, depending on whether you choose a traditional or Roth IRA. They also offer a wider range of investment options. A 401k, on the other hand, is employer-sponsored and typically offers higher contribution limits. Many employers also match part of your contribution, essentially giving you free money for retirement. Automatic payroll deductions make it simple and consistent. Many people benefit from using both options. Start by contributing enough to your 401k to secure the full employer match, then add savings into an IRA to diversify your tax benefits and investment choices. Combining both accounts can help maximize your long-term financial growth. Avoiding retirement planning mistakes is just as important as saving. One common error is failing to increase contributions as your income grows. Even small increases over time can make a big difference. Many people also underestimate what they'll need for retirement, especially when it comes to healthcare, inflation, and lifestyle choices. Relying too heavily on Social Security is another mistake. It's designed to supplement your income, not replace it. Regular reviews of your retirement plan are essential because your life, income, and goals change over time. Skipping these reviews can leave gaps in your strategy. Avoid taking early withdrawals from retirement accounts unless absolutely necessary. Penalties and lost growth can set you back years. Make sure your investment mix matches your age and risk tolerance so you're balancing growth with security. Don't forget about taxes and the importance of having an emergency fund. Both are essential to protecting your retirement money. Knowing how much to save in each decade can help you stay on track. In your 20s, aim to save 10 to 15% of your income and focus on building good habits. Even small amounts grow dramatically with compound interest. By your 30s, increase contributions as your income rises and try to have at least 1 year's worth of salary saved by age 30. In your 40s, work towards saving 3 times your annual salary. Maximize contributions and reduce debt to free up more money for retirement. By age 50, aim for 6 times your salary saved and take advantage of catch-up contributions if available. In your 60s, the goal is to have 8 to 10 times your salary saved. This is also the time to plan your withdrawal strategy, consider when to take Social Security, and review healthcare coverage to ensure a smooth transition into retirement. If this video helped you understand accounting a little better, don't forget to like, share, subscribe, and turn on notifications for more accounting tips and guides. See you in the next video.